What happens if the market is waiting for rate cuts, but the Federal Reserve says not yet? That's exactly where we are now. US interest rates are still in the 3.50 to 3.75% range. Inflation has climbed back up towards 3.8%. The 10-year yield is hovering around 4.6%, and oil is trading above $105. So here's the real question. If interest rates stay higher for longer in 2026 than the market was expecting, what does that mean for the dollar, gold, and oil? This video is about that whole chain reaction, how a single decision from the Fed can shift the path of several major markets at the same time. Section 1. What is the market pricing in now? Not long ago, many people thought 2026 would be the year of rate cuts. The idea was simple: the dollar would slowly weaken, gold would breathe more easily, and risk assets like crypto and stocks would enjoy better liquidity conditions. But the latest data has complicated that picture. Inflation is still above the Fed's 2% target. Oil has brought inflation worries back onto the table, and the labor market hasn't weakened enough to force the Fed into fast rate cuts. So now the conversation isn't just when do cuts start. Three scenarios are on the table. Rates stay the same where they are, cuts come later than expected, or if inflation flares up again, the Fed even hints at another hike. That's where the traders have to understand that the policy rate isn't just an economic number. It shapes how the entire market thinks. Section 2. 3 key scenarios for 2026. Scenario 1. Rates stay unchanged. The Fed doesn't rush into cuts and wants a few more months of data before moving. In that case, the dollar can stay supported, gold might not trend in a clean way, and risk assets move forward more cautiously. Scenario 2. Rate cuts come, but later than the market had hoped. Cuts are still on the table, but the timing shifts. Markets that already priced in early and aggressive easing could see deeper pullbacks or choppy volatility as expectations get repriced. Scenario 3. The surprise scenario, another hike. If oil stays high, inflation pushes harder, and the US economy remains resilient, the market may have to take the idea of higher rates more seriously. That scenario tends to be more positive for the dollar, more complicated for gold, and pressure building for risk assets. Section 3. What it could mean for the dollar, gold, and oil. For the dollar, higher for longer rates are a major support. As long as the market believes the Fed is not backing down, the dollar can stay relatively strong, and pairs like Euro versus US dollar, Great British Pound versus US dollar, and US dollar versus Japanese yen will react sharply to inflation data, job numbers, and Fed's commentary. For gold, the story is two-sided. On one hand, geopolitical tensions and risk aversions can support it. On the other hand, a strong dollar and higher yields can cap its upside. That's why gold can get supportive headlines and still fail to fly. It might spike quickly, then get dragged back by the dollar and bond yields. For oil, the effect of interest rates is indirect but important. High oil prices can keep inflation alive. Higher inflation can make the Fed more cautious about cutting. Higher rates can then weigh on growth expectations and, in turn, on oil demand. So oil is both a driver of inflation and a market that reacts to rate expectations. In 2026, oil stands at the center of the interest rate and inflation puzzle, not only in the energy story. 2026 rate outlook is no longer a simple straight line. If inflation drops, the Fed can move closer to cuts. If oil prices stay high and inflation remains sticky, rates may remain elevated for longer. If the market starts to price in another hike seriously, the dollar could strengthen further, gold's path could become even more complex, and oil could be caught in a delicate balance between inflation risk and demand risk. For traders, the policy rate today is only the starting point. What really matters is which scenario the market believes right now: steady rates, later cuts, or renewed hikes. Your turn. As you look at the rest of the 2026, which market do you think will react the most to Fed decisions? Dollar, gold, or oil? Share your view in the comments.